Good afternoon, everybody. I'm delighted to be joined today by Dr. Amrita Sen, co-founder and head of research at Energy Aspects, to discuss the question, sell in May and go away, where does one find certainty in the oil markets to go long in 2024? Amrita, thanks so much for joining us.
Well, thank you for having me. It's a real pleasure to come back.
Well, great to have you. Let's start by looking at sort of the demand picture, then we'll talk a bit about supply as well. But just this is a forward look into 2024. But in 2023, we did see an increase in oil demand of 2.3 million barrels a day. A lot of that coming from China, as expected. But we saw the picture weakening as the second half of the year went on in terms of demand, complemented by supply. Softness, if you like. Despite the OPEC plus cuts, we still saw a lot of supply because demand wasn't taking it up. So a bit of a surprise to expectations earlier in 2023. So would you agree that we are in a sort of risk off mode as we start the new year?
I think we are in a risk off mode. Right now, we've got a bit of risk on in terms of the US freeze offs, big winter storm potentially coming and hitting Texas. And I think that's kind of boosted prices a little bit. Of course, geopolitical risks and what's going on in the Red Sea with the Houthis attacking a lot of vessels. That's obviously creating a lot of impact in the shipping market more than anything else. And that is having an impact on Middle Eastern grades like Dubai. We've seen kind of the backwardation in Dubai jump up as well. But those are kind of more specific factors impacting specific kind of more physical market rather than the outright price of oil. The market was, for a lack of better phrase, badly burnt last year for a lot of people who had gone long. They are on the sidelines, and I just don't think there's confidence enough in the market for these traders to come back and go long yet, because fundamentals, I mean, they're not weak, but they are not strong either. And you don't have anything in the curves, either in the crude market or in the products market, that's hugely mispriced, right? And that's for anybody to go long, you need to have the confidence that, okay, this is good value. Now, if you look further out into 2024, summer onwards, we do think, just seasonally refinery runs will go up. And you're going to see the bigger impact of the OPEC additional supply cuts as well by that time. And that part of the curve does look quite attractive for traders. But, we are staring at big refinery maintenance. So why go long right now, right? So I think it is not necessarily risk off in the sense that I don't think we're going to come off more, but it's more that there is no risk appetite.
Okay, well, let's talk a bit about OPEC plus then. Maybe we'll tackle the supply side of things first, and then we'll get on to demand and look at the global economy and expectations there. I mean, you mentioned OPEC plus. They announced an additional round of cuts in November to be implemented through to the first quarter of this year. But prices are still very comfortably in the low 70s, let's say, and they have been really for a couple of months in the midst of, as you said, geopolitical tensions that came on board at the end of last year in the region here in the Middle East, etc. So again, I mean, I suppose the demand weakness sort of biting in there, but from an OPEC plus policy point of view going forward, Amrita, do you think there's any more that they can do, or do we just they have to accept that this is the fundamental situation? How can they afford to cut any more of their capacity?
I would say, look, if there is a real demand shock where, for whatever reason, the global economy were to come to a standstill, again, let's not speculate as to what the reason could be. I do think OPEC will come together. We've seen them do that in 2020, big cuts, but that's not where we are right now, right? What they are looking to achieve is stability. These countries are revenue optimizers, I would call them. What they are looking at is, okay, if we didn't cut, what would prices be? Versus with the cuts where prices are today. And I think that's what we are facing. Brent's been between 75 and 80, I would say, for the second half of December and even now. WTI is weaker, but WTI doesn't really affect OPEC, right? OPEC really cares about Brent and Dubai in terms of their revenues. And, we were close enough to 80. I do think we'll get there again. We'll kind of be around that $80 mark, and that's fine. That's a comfortable place given the economic backdrop. I think OPEC will take that. The one thing I would say is that for all the talk of demand weakness, yes, Chinese demand decelerated a little bit into year end. But questions like, oh, China never showed up. Chinese demand grew by 1.6 million barrels per day year on year. I don't know what more people want out of China, right? The big change in the market last year in terms of balances was actually US production. It was US supply surprising everybody to the upside, including US producers who we talk to all the time. They themselves didn't expect so much. Lot of that driven by M&A. And I think that's what shifted the balance in terms of the market fundamentals. Sure, demand isn't like roaring, but demand isn't weak either.
Okay, and I mean, you mentioned US and, in terms of non-OPEC supply. I mean, that is, as you said, it surprised people. We also had Venezuelan and Iranian oil in smaller amounts sort of coming on stream,
Yes.
perhaps also unexpectedly in terms of the numbers. So again, I mean, are we going back now to a market share concern for a group like OPEC Plus? And we had Russia producing more than it ever has in 2023, although it's part of the group, although it's meant to be under these quota cuts. So how much of a concern is that, do you think, for the group going forward as they plan the year ahead?
I mean, look, I would say from OPEC's standpoint, if you look at Iran, Iran has already done what it can, right? The US has turned a blind eye towards Iran, and you've seen Iranian exports go up by about 700,000 barrels per day last year. But that was a first half story, and we have seen that. Like, there's no more coming through from Iran. Venezuela, yes, we are expecting a little bit more coming through from them as well. But that's minor. In some ways, I would argue OPEC has already dealt with the bulk of the big increases in supplies from at least other OPEC plus nations. Now the question is about non-OPEC. It's Guyana, Brazil, US. And we have seen, and Guyana and Brazil will continue to grow, but US will again grow this year, but at a slower pace, for sure. And I think that's where the balancing mechanism comes in, right? That's where the questions come in about OPEC Plus, is that, okay, will they continue to hold this policy even as non-OPEC is growing? And again, some non-OPEC growth is to be expected as long as the US isn't growing by 2 million barrels per day, which it isn't. I think, again, OPEC and cohesion is still very, very strong. So I think that will be fine. But that is what I would watch for, that the US side of things, is it slowing down, or what are we seeing in that space?
Okay, let's switch back to demand a little bit and look at sort of the global economic picture. You mentioned China wasn't as bad as some people were saying last year, but what has changed, and I suppose what brings perhaps stability, is that we know now China is in a new growth
Yes.
paradigm, right? We're
Yes.
expecting a little bit less next year, 4.5%, 4.3% growth. So has the market accepted that? And given that, volatility, et cetera, do we expect to see as much of that going forward this year, or are we in a more stable place, including the sort of expectations for central bank Fed policy and where interest rates go?
I think that's a great question because look, does the market or has the market accepted China? I mean, who knows, right? Because for me, 4.5%, 5% on a much bigger base of Chinese GDP now, right, is still extraordinarily strong. Like the US can't grow at those kind of levels, right? But China still can. I think the market's mindset is still set at, oh, China should grow by 7, 8%. That does still need to change. I think it's shifting, but not shifted yet. But for crude, China still is the biggest buyer, right, of crude. And I think that's where the swings come in. The bigger impact on Chinese crude buying, much more than domestic demand, has actually been their product export policy. They curtailed that. They basically said, and this has been their policy the last 3 years, is that we are not going to be exporting so much clean products and polluting our own skies. Whether that's right or wrong, that's their policy. I was in China twice last year, and the message from every single state-owned company and medium-sized refiners was very, very clear. The government isn't going to give product export quotas in abundance. The first round of quotas we've seen this year absolutely confirms that. The market was expecting 30 million tons. We only got 19. And the trend, and the government wants to reduce the amount of quota. So the issue for China is that domestic demand is growing, fine, but their refining capacity is a lot more, right? And therefore, they always have bought crude not just to produce domestically, but also to export to the market. And that's the bit that we will see less and less of that. which is bullish for refined products. And we've seen refining margins do a lot better. But that's kind of more on the, I would say, the China crude side. Economic growth wise, yes, I mean, stable to slightly lower. The bigger challenge to your question, or the bigger uncertainty, is Fed policy, right? Now we are pivoting towards Fed having to cut rates, whether it's 3 or not. I think, of course, they did come out and talk about that already. Fed has probably over tightened. I think that's fair to say, given the economic backdrop already. And we've started to see, credit card kind of, or credit ratings of a lot of companies going down, consumers starting to hurt. So I think that's where the uncertainty is going to be, that has the US economy slowed already too much? Is the Fed going to be able to cut in time? And I think that is going to keep demand growth in check a little bit. Again, it's not weak, but it's definitely not going to be like 2.5 million barrels per day again, right?
Yeah, and I mean, so you do see that sort of Fed policy, although more predictable going forward this year.
Yeah.
Yes, they may cut or not, but we're looking at a staying between 4 and 5%, let's say, as opposed to the rise of 5% over less than 2 years of the last recent period. So there we see a bit more stability in terms of market expectations. But you're saying that you do see corporates and there's the real effect of those rates perhaps starting to pinch on the
Yes.
US economy, because so far we've seen a soft landing in this sort of inflation reduction policy, if you like. And that surprised many people too.
Yeah, I mean, our view is also that it will be a soft landing, but it depends on how you're defining a soft landing, right? We think GDP growth slows. We could get 2 quarters of quarter on quarter, like mild decline in the US. Look, rates always have a lag with which it affects the economy, right? It's never going to be overnight. And you are starting to see some stresses in the low income groups. And that's what we will start to see kind of manifest itself through kind of the course of this year. So we're not expecting demand declines, but we're not expecting growth either. Last year, US did grow a decent amount.
Okay, what about Europe? Let's just touch on that. Not necessarily the biggest consumer, but clearly it's adjusted itself now, of course, on the gas side from its reliance on Russian gas. But it was, I suppose, held responsible for that fourth quarter revision in downward demand forecasts
Yes.
that we saw at the end of last year. What's the view ahead? Inflation's coming under control.
Yes, and I think, like to your point, Europe is never really the focus and shouldn't be, right? It's not the biggest demand growth center at all. But I think the question is, we know demand is going to decline, but how much, right? Last year, actually, demand didn't decline by as much as we had expected. It fell, but by less than. And the question is, can it do a repeat of that this year, right? Sure, it will decline by, let's say, 100 to 200,000 barrels per day. That's manageable given the growth we've got elsewhere, whether it be India, the Middle East, and Latin America. But if suddenly, for whatever reason, the European economies take another step down and we get a demand decline of, let's say, 500,000 barrels per day, then it is material. Not our expectation. And to your point, I think the worst should be in the kind of behind us in the rearview mirror. Some of the high frequency data we track in terms of trucking miles, for instance, starting to tick back up again from a very low base, but it's not getting worse, that's for sure.
Okay, and what about Amrita? Let's talk a bit about Russia. I mentioned it a bit earlier within the context of OPEC Plus. Again, they've pledged cuts along with the other members there. What's the outlook for production there going forward in terms of domestically there, on the ground? Is Russia feeling an impact in terms of being able to produce what it wants to, regardless of quotas? And do you see any difference in where we might see Russian oil flows this year compared to last?
Russia has been cutting. I mean, look, they've talked about cutting exports rather than production, and that's why that confuses a lot of people in the market. But if you look at the numbers, yeah, they have been cutting by about 300, 400,000 barrels per day. Month on month, those things vary. Like in November, they actually ended up over complying with the 300,000 because there was these big storms that resulted in just ships not being able to move around. But then those ships did travel in December, and so the December numbers look like they didn't comply as much. And I think the one challenge Russia always will have in the winter is weather, right? I think they're starting to front load a lot of their exports in January because of kind of the ice season, and the ice vessels are always costlier. So to avoid that, which kind of starts to kick in the next couple of days. So you're going to get some of those in inter-month volatility, and that's why we always look at full month data. But yeah, it's a big country and it's a lot of producers. So managing that, it's not one single national oil company, right? It's not easy. But yeah, the compliance has been there. November, December, on average, they complied with the full 300,000. Month on month, it varies. One very interesting thing we've seen is that usually at year end into Jan Feb, they tend to destock a lot every year. Go back in history and you'll see that. But to prevent that, Novak actually ordered them to cut production earlier this year. So outright production actually came off 100,000 barrels per day, or almost 100,000 barrels per day, 60,000 in December again, right? And they're going to maintain those production levels into January. So they are definitely trying to comply as much as possible, even with the challenges that they have. In terms of their exports, most of their exports, or rather I would say, yeah, most of their exports continue to come to Asia, with the rest of it going into Turkey. There won't be any changes to that. But what we are seeing, very interestingly, India used to be one of the biggest buyers, still is right now, but you are starting to see less Russian oil going into India because Russia is actually finding better value in sending this oil to, say, China. And that's an interesting development because India is now having to go to Middle Eastern buyers, UAE, for instance, Saudi Arabia, for instance. And I think that's an interesting dynamic where you could actually say from India's point of view that we were there for you when you needed us, but now that you're getting a better price, you are no longer supplying us with the oil that you promised us or whatever. So I think that's a development that's going on right now, and that should be watched.
That's interesting. Let's just stick to the OPEC Plus. You mentioned compliance. Of course, we've talked about Russia. We've talked about the cuts, the voluntary cuts as well, by both Russia and Saudi. The quotas that are meant to be under discussion as we go ahead into this year, new quotas. Some discussions happened at the end of last year. One result was Angola withdrew. It wasn't happy with the signals it was getting. Brazil is joining OPEC Plus. So a lot of dynamics in that group. Is that a positive thing, do you think? Is it, and how much confidence does that give the market as a signal on how solid that group will be going forward in managing its part of the market?
I think managing its part of the market, it's done it over the course of the last few years, really, and the market shouldn't question it. I think one thing traders always forget is that OPEC Plus aren't there to create volatility for them, right? Traders love volatility. OPEC Plus is here to provide stability to the market. And I think that's where people get confused a little bit. In terms of Angola, yes, as you said, they weren't very happy with, the reduction. We all know Angola is struggling to increase production, but fine, they decided to leave. But since then, you've seen enormous amounts of support come out from other African countries, obviously the Middle Eastern OPEC countries, kind of for cohesion or saying in support of cohesion. So I don't think that's an issue. Brazil, by the way, isn't joining OPEC. To clarify, it's simply joining as an observer, for a lack of better phrase. It's just kind of, it's within the charter. But again, Brazil has ambitious growth targets, and I don't see Brazil joining and being and curbing output, right? So it's more that, yes, it's a part of the alliance in terms of the charter, but it's not going to be cutting output.
Okay. You mentioned, Amrita, geopolitics at the beginning, and what we didn't see happen in the last quarter, especially. I mean, the Ukraine issue has settled into this, I suppose.
It's now like
the market has settled as a result, that we haven't seen any further disruption, let's say, or anything different. Of course, we have conflict here in the Middle East, and the fundamental physical side of that has manifested only in the last 2-3 weeks, really. Red Sea, etc. And yet we still see an oil price that really hasn't budged much. Again, is that just simply a reflection of we have plenty of supply, or we have weak demand expectations? That risk premium, is it going to show its head this year, do you think?
I think it only shows its head in the summer months if the geopolitical, issues continue, because right now, seasonally, it's the weak part time for demand, right? It's refinery maintenance. You're not going to get crude to rally really in Q1, early Q2, because this is when refineries are not going to be buying crude. If anything, I have been impressed how spreads are trading right now, because it does show there are some stresses in the market, because refineries are, they're not buying enormous amounts because of maintenance, but because of all the issues with the Red Sea, they're having to, particularly in Asia, they're having to pay up a premium, right? Or they're having to go short haul. Middle Eastern crude is actually benefiting as a result of that. We've seen a massive spike in freight, particularly the US Gulf Coast to Asia route. And that's why a lot of Asian refiners are going to go and buy Middle Eastern grades as a result of that. But one of the things, I think the reason you don't have a geopolitical risk premium is because people need to be convinced that, okay, we are going to go long, right? Once people are long, then you kind of get that geopolitical risk premium being priced into the market. Right now, to your point, the market's balanced. It's fairly balanced. So, and none of the kind of attacks either have really affected oil directly, right? It hasn't been on an oil tanker. What it's resulting in is much longer routes for oil tankers. But I think that's the other thing. If there is an outage, and by the way, Libya, we are seeing some outages right now. Those things, once you kind of get a few of that and it starts to tighten balances, that's when the risk premium will come.
And particularly, as you said, with the cost increases for all operators with interest rates. I mean, talking about that and in terms of fundamentals, physical, there's no actual disruption yet. And many people last year at OPEC Plus leadership would say that actually this market is being run by money managers, algorithms, etc., more than fundamentals, and therefore that's why we're coming in to provide a bit of stability. Would you agree that's what's going to? I mean, you said no one's prepared to go long at the moment, but is that what's going to dictate where prices go this year again, or will we see people paying more attention to fundamentals, or is it simply the liquidity in the market? What positions are people prepared? Those big hedge funds.
I think, look, they are interconnected, right? Hedge funds don't trade in vacuum. They come into the market when fundamentals are strong or weak, right? By going long and going short. So they are very, very connected. I think the thing that makes the volatility increase are these algorithmic trading, right? CTAs, who really don't look at fundamentals. And we are getting more and more of those. And understanding them is important. And I think that's where the distortions are created, I would say. And yeah, I mean, they are within a range, right? I mean, they lead to, say, $10 on either side, which is a lot of volatility, but they are not going to be the ones that lead us to $40 or $100, right? That's how I would put it. I think fundamentals are stable. I think prices will be in the 80-ish for Brent, not for WTI, but like for Brent this year. I am not expecting a lot of volatility, in part because, the volatility is caused by more trading activity. If traders stay on the sideline and you have genuine fundamentals, yes, demand is growing, OPEC Plus is managing the market, I think you are going to get more stability than if you get a lot of inflows and then you kind of get the outflows as well again.
Okay, so you said it's interesting. You said $80 for this year on average. We do have a survey question I'd like our team to put up and see if everyone else agrees with you, Amrita. I mean, we had in the fourth quarter of last year a lot of bullish sentiment still. That sort of slowdown hadn't really kicked into everybody's books, and some people were saying we're going to see $100 again before the end of the year, and how quickly things change. So there's the question for today, which is, what will the average price be of Brent this year, closer to what? And you've got a 60 to 90 range there. You're on the higher end of that range, higher than where we are today. And certainly, I'm going to put mine right there just for a second. Yeah. But I mean, what do you think spurred that optimism at the end of during the fourth quarter last year? Was it just people talking their books, or was there something expected that didn't materialize?
There was genuine tightness, in August, September, like the tightness we've seen, because it's not about people talking their books, right? If you look at time spreads, we had $2, $3 backwardation in Brent, in WTI, in Dubai. That is not a market that is just, high for no reason. That's genuine physical tightness. So I do have an issue when people are like, oh, people got the forecast wrong. We were calling for $95 oil as well at that point. And of course, you can touch 100. Like, I mean, we never had a $100 forecast, but it's like, of course, you can trade there. We almost did. What the single biggest thing that changed that outlook was US production. Because the surge we saw, and it really happened from around that end August timeframe. It was that summer surge, and it was so tied to M&A activity. We had a huge amount of M&A activity, and if you drill down, we have the data for it into well-level numbers. You could see that the companies that were getting bought were surging production. And that's just something, that's also why I think producers themselves were surprised, because obviously not everybody is aware of all the M&A that's going on, and nobody expected that to be the real driving force. I think that is something that really caught everybody. All our balances, the single biggest line item that shifted. China, yes, it slowed down, but not like the swing in US production was much more.
Oh, that's interesting. And we have a session later in our US America session on that, actually. But would you say then we're expecting that production that tipped again above 13 million barrels a day to increase this year as that cash comes in from those sort of super majors, or will we just see it plateau where it's hit?
No, it'll grow. I think the growth wasn't the issue. We were also expecting growth last year, but say we were expecting growth of about 600,000 and it came in at about 1 million. Right? I think that's where the mismatch was. Usually after M&A activity, growth slows because the bigger company that takes over the smaller company, they actually never deploy all the rigs because the smaller companies tend to have worse acreage. You actually don't use up all the rigs and the wells, right? But what we saw was just ahead of that, the smaller companies surging production. So growth, we are expecting it to slow this year. The question is that, okay, we are expecting, let's say, about 600,000 barrels per day of growth. If that's the case, I think the market's fine. If it again turns out to be 1 million for whatever reason, I think that's when the market balances go out of whack a little bit. But if growth is actually slower, because remember, the base of production is a lot higher as well. So they need to keep drilling to offset decline rates. And if let's say the growth actually ends up being 300,000, that will provide some tailwinds for prices to go up in the summer.
Okay, well, Dr. Amrita Sen, we have, I'm afraid, run out of time already for this interview. Thank you so much for joining us today for the Global Energy Outlook Forum. And there's the result, 80. Everybody, most of our audience seem to agree with you, 55%. Nobody's going down to 60. So that seems to be possibly where we're going for an average this year. Thank you so much for joining us,
Thank you for having
Amrita.
me.
Great to have you. Thank you so much, everyone. Bye-bye.